Hello. Welcome to Mayor Brown's webinar, Understanding and Minimizing COVID-19 Fraud Risks. My name is Rich Rosenfeld. I'm the co-lead of the U.S. Securities Litigation and Enforcement Practice at Mayor Brown. Joining me today to present are Gina Parlavecchio and Michelle Natal from our New York office, members of our white-collar defense compliance practice. I'm very excited about today's presentation. I'm really interested myself to listen to Michelle and Gina. I think we have a lot to say. But before we begin, we'd like to mention a few housekeeping announcements. So I apologize for reading this, but it's literally the script at the start. Please note, when accessing Mayor Brown webinars via our WebEx platform, we suggest avoiding software such as Citrix to decrease disruption or quality loss. Secondly, today's program is being streamed through your computer. For best audio quality, please make sure your computer speakers or headsets are turned on. The volume is up so that you can hear the presentation. Seems relatively self-explanatory, but we mention it anyway. If you have any questions that are unanswered during the presentation, I invite you to submit questions using the Q&A feature at the bottom right side of your screen or the right side of your screen today. We'll do our best to answer questions live. Or, of course, after the program today. If you want to email myself, Gina, or Michelle at any time, feel free to ask us questions. We'd be happy to answer them. And regarding CLE credit, we'll provide an alphanumeric code during this presentation, I believe twice. In order to receive CLE credit, you must record the code on the virtual sign-in sheet that was emailed to you along with the login instructions for today's program. So please return that form within 10 days of the event or you will not receive credit. So with that said, let's get started. Next slide, please. So this is the general agenda of what we're going to talk about today. Luckily, I can just turn it over to myself because I'm going to start us off. And the agenda is that I plan to set the table a bit. I mentioned that I was very excited about this. I think it's a somewhat unique opportunity to make a presentation. You've got myself, who at this point, it's been quite a while, but I spent some good time at the beginning of the TARP program, which was the Special Inspector General over the TARP program, building up an Inspector General over the last economic bailout, or stimulus, you could say. Gina has joined us very recently from the Eastern District of New York and has a real insider's perspective on the government and prosecution, which will be highly interesting. I'm very excited to listen to that myself. Same with Michelle Natal, who has joined us from a very large financial institution, spending over a decade there in their legal office and really specializing. So I don't mean to short shrift you in legal and compliance and also regulatory. I'm really interested in that perspective as well. So that's what you're going to see today and get to hear from us all the way along the way. So next slide, please. As I said, I'm going to set the table. So you may have seen this many, many times in the past, but it's essentially a very simplistic fraud triangle. It's how lots of folks like to teach fraud and what the incentives and where fraud comes from and why. I like it myself as a general understanding. And so there's not a lot to say here that you don't already know, but it makes sense. It's essentially called the framework of spotting fraud internally, and that's something we like to do here today. Since we have these perspectives, I think we have some ability to talk to you today about practically what the government is thinking, practically what your institution should be thinking internally. And I, again, am going to set the table a little bit about practically why we think that there's a fairly significant increase in fraud risk here, particularly with the pandemic. Not to belabor this slide, but it will make a lot of sense. But in times of a pandemic where there's economic stress, where stimulus may be allowing certain folks to move along the road but not have foreclosures or other issues arise yet, where others are feeling stress in their family, where health issues may have arisen that cause a financial stress, those are all pressures that weren't there before the pandemic. The fact that we're all working remotely and there's a new method of compliance and regulatory of oversight of how do we do this? Do we have enough IT infrastructure to make sure we're locking all this down? there's potential opportunity that hasn't existed in the same manner before. And rationalization comes from both of those things in some ways. The need to take care of one's family, oneself, the need, the ability to potentially do something that you weren't necessarily able to do before, or think there's less risk of being caught because you're in your own house and it just seems like you're not going through the company servers, even though you probably are. Those are all things that I think cause this triangle to have a bit, just on a standard basis, a bit of a greater possibility of fraud. But where I'm going to talk and set the table, as I said, about specifically all of the things that are going to cause a larger amount of what we think will be fraud cases, fraud investigations, need to do compliance and regulatory monitoring work, documentation, and upgrade inside each and every one of your systems. So next slide, please. Look, an easy way to talk about this is stimulus. When you're talking about more than $4 trillion that has gone out of the United States government, and you're talking about specific programs like PPP, which I'll spend a little time talking a little more about the details and where some of the issues will come from. And you're looking at, more than $650 billion that's gone out in that program. You've got a real possibility that there will be fraud involved. In fact, we've already seen it, and I think Gina's going to talk some about that as we get to her, and I don't want to steal her thunder. But let's talk a little bit about what the PPP program is. I think that's what I'm here to do. I'm sure you've heard so much about it from every other panel you've ever listened to or webinar you've had over the last 6 months, 8 months, so I don't want to do too much. But essentially, the idea behind it, of course, was to keep America employed, to help small businesses, at least theoretically, you could see it there in quotes, make payroll. And next slide, please. That's all things that were the intentions of the program. A couple of the requirements, and in a second, although don't go to it yet, I'm going to go to the next slide. But for now, the idea for the program was that it would be 75% used for payroll. You couldn't be a bankruptcy debtor. There was a necessary certification. We'll talk about that. But at the end of the day, that program started to roll out in March, towards the end of March. By April 3rd, there was already a joint statement by federal and state banking regulators that they would be flexible as to the requirements of the program. Just a couple months later, there was literally a Flexibility Act signed into law, which gave a greater latitude in what any entity who received PPP funds could use the funds for. So now, next slide. There all sorts of things started to come in to try to at least define or explain what was meant by certain of the controls that were put in place at the beginning of the program. So the PPP required that there would be a good faith certification by anyone who applied for the funds, that the uncertain economic conditions made it necessary for the loan, and that you had to have it. And you'll see in a second, but also the SBA had a little bit of a different framing of that. And the SBA realized it's not the SBQ. I noticed that there was a small typo there as I tried to figure out what I meant by SBQ. But the SBA, and that's just the Small Business Administration, put out an FAQ, essentially stating that, look, what we're trying to do is say, just make a certification with good faith. Make sure that you don't have another source of liquidity in some way, and that that wouldn't be significantly detrimental to the business. And then there was a statement made that loan with original principal amounts of less than $2 million would be deemed to have made that certification about necessity in good faith. Next slide. So what we're talking about here, and I'll get to this in a second, is that the program was loosened to an extent to make it more accessible, easier to use the money. And so it really becomes a question of, and I'm interested to hear Gina's thoughts later on this, and Michelle's, I think it's going to be interesting sort of when prosecutors certainly try to address these programs, are they going to be able to rely on a false certification claim? Are there things that I think that's going to be a very hard claim to rely on at the end of the day. what we're seeing so far, and again, we'll talk about this more extensively as we go, is a lot of fraud. A lot of out and out fraud, and that I think will always be there, and that will always continue. If entities were set up that were fake just to tap into the funds, they're going to go after that. But I want to bring us back to setting the table again. Look, anytime there's a huge financial outlay by the U.S. government, there's going to be enforcement and litigation that come in the future. And so what you need to be thinking about is that the way enforcement is looked upon these days is not just entities, but also individuals. The SEC just put out a statistic a couple of weeks ago that over 70% of its cases have a charge against an individual in the last year as well. And that's an increasing figure. And it shows a real desire by the agencies to be able to say that someone is actually either committing or assisting with these frauds. And it's not just a fraud that happens in the ether and going against the entity as we often did in the past is a way to sort of settle the matter. They wanted individual scalps as well. So you have to look at, I think, both sides of the equation. You're going to have to look at applicants and all the things we just spoke about briefly, because I don't want to inundate this program with a PPP review when I know you've had that in the past. But you have to look at the certifications, any disclosures that were made, any representations, and obviously if there's significant or material omissions, that's going to be a really big deal later as well. But you also have to look at the lender side. Interestingly, and again, Gina, I don't want to steal your thunder. There's been a case from a large lender side entity, but it was individuals inside that entity that created their own false company or companies, as I understand it, and then at least in the allegations, took money from the program. That's, I think, one way to look at it, although that's almost still the applicant side. But you're also going to have to look at underwriters, whoever handled the application, the decisions that were made internally. You've seen a couple of lawsuits out there talking about priority and whether or not priority was appropriately given by the folks handing out the money, particularly in the very first stimulus program before they re-upped and gave more money to it. There was a real question about those who had the ability to hire experts, legal counsel, consultants, were able to more easily access the program than those who didn't. So that'll all be questions. Next slide. So here's where I think I can add something that might be slightly different than others. And I don't want to take us back, more than a decade, but I will for just one slide and say, when we were standing up the Special Inspector General over the TARP program, it was the first time that a Special Inspector General's office had ever been created over money, rather than over an entity. Usually it's the Special Inspector General of HUD or DOJ or any other entity in the U.S. government, DOD, pick any of them. They all have Special Inspector Generals who are supposed to independently review the entity and look for any potential wrongdoing. In this particular case, this was over money. So at the end of the day, one of the questions is, the Special Inspector General has no prosecutorial authority on their own. So it became a matter of teaming. And I think that's going to be very much what's going to happen today. That's going to be very much what you're going to see across the task forces that will be created for the new stimulus for the pandemic. So you're going to see entities like, and we're going to talk about this in just a second, SIG-PR that was created over the stimulus funds, just like SIG-TARP, FRB, FBI, FinCEN, all of these folks, along with the SEC, IRS, all of these entities will get together, work together, share information and manpower across. And so all of these entities are going to be things that you want to make sure you are aware of. So at the end of the day, really, it's the same expectation that you should have as you've had before. So next slide. There's going to be agendas and budgets that are going. The reason I have agendas and budgets in the title is that is going to be the focus of each of these entities. Every one of these entities that we've talked about and that you look at on this slide are entities that were either created specifically to oversee, 3 of the bullets are specifically to oversee the stimulus programs, or entities that have pledged that they are going to be the ones who assist investigating, bring cases, bring prosecutions, bring litigations, and civil cases, and are all going to have an agenda in which they want to be showing the American people that these programs were serious, that there's oversight over them, and that there are things that they want to give comfort to the American people that their money, taxpayer dollars, were used appropriately. And budgets matter. The total outlay annually for SIG-PR, for example, is $25 million a year for 5 years. So you're looking at $125 million for SIG-PR taxpayer funds, and they're going to have to justify that. So just rolling down this list quickly, you've got the Pandemic Responsibility Committee. By the way, it named itself the committee. I love that. When we get down to the Congressional Oversight Commission, I want to see if you guys can figure out what they've nicknamed themselves. It's, spoiler alert, it's the commission. I love the genius names that the government comes up with. But you've got the Accountability Committee, which is looking into to detect fraud, waste, abuse, and mismanagement in any of the programs. SIG-PR, which is a Special Inspector General over the money that was outlaid in the pandemic. And SIG-PR has full subpoena power, a broad ability to investigate anything, and can team with any body that it feels is appropriate to bring a matter. So it could be DOJ, could be U.S. attorneys' offices, it could be attorneys general in the states, it can be local DAs if appropriate, it can be any of the civil agencies, the bank regulatory agencies, the SEC. There is a myriad of places that have, in quotes, prosecutorial power, whether it be criminal actual prosecutorial power or a civil ability to bring a case or claims on behalf of the U.S. government. Those are all places I expect there to be working together and communication between. And at the end of the day, I expect SIG-PR will be adding manpower to all of those places with an agenda that says they're specifically looking for fraud, waste, and abuse in the stimulus and bailout programs. And so when you look at it in this way, and you see the amount of resources that the government has mustered to ensure that these programs are at least policed in some manner and overseen, it is undoubtedly true that you are going to need to be cognizant that there's going to be a ratcheting up and an increase in the amount of cases you're going to see that are tied in some way or another to the stimulus program, to the bailouts, to pandemic issues. And this, I think, is a perfect segue, if I may, into Gina's presentation. Gina, I'm going to turn it over to you from there.
Thank you, Rich. So I think federal law enforcement agencies foresaw this fraud triangle that Rich presented at the beginning of his presentation because since the onset of the pandemic, regulatory and law enforcement agencies have issued numerous bulletins warning the public about the risk of fraud relating to COVID-19. And it covers the gamut of the alphabet soup of federal agencies. There have been advisories from the Small Business Administration, FinCEN, FTC, FBI, HHS, DOJ, and states attorneys general as well. And what's clear from these advisories is that the types of fraud risks during COVID-19 pandemic have really run the gamut. And as the pandemic wears on, these frauds all appear to be not only on the rise, but they're evolving. Now, at the very beginning of the pandemic, the fraud mainly related to price gouging and fraud relating to personal protective equipment or PPE, scam COVID treatments and the like. But as I said, the fraud risk has really evolved. And so as more pandemic relief has come online through the CARES Act, which included PPP and enhanced unemployment benefits, the schemes have become more sophisticated and have required a lot of resources from law enforcement to address these issues. And as Rich said, the fraud risk has just become even more heightened because of the work from home environment. And what we've seen repeatedly is that employees not only are sometimes, as Rich alluded to, committing fraud because they're working from home and they feel like people can't see what's going on in their house, but also companies' employees are becoming victims of these frauds as a result of the increased work from home environment. There's cyber risk inherent in having people work on their personal laptops, using other personal devices for work that may not be as secure as their work-issued devices, or maybe they have less secure Wi-Fi networks at home, they have their kids working on it, so it presents all of these risks. And in recognition of that, law enforcement and regulatory agencies have really stepped up their warnings to the public about the types of things that they should be on the lookout for. Next slide, please. Now, one thing we've really learned from these advisories is that fraudsters aren't spending their time during the pandemic baking banana bread and coming up with new TikTok dances. They're coming up with new ways to part people with their hard-earned money, and so they're doing that in a lot of different ways. Identity theft, business email compromise scams. We've seen advisories from the FBI about this type of a scam, which involves a victim receiving an email from a seemingly known and trusted source, and then being tricked into sending a payment or payment information, and with the misimpression that they're transacting legitimate business. And we're actually, I'll give a plug for a CLE we're going to have in a few weeks in regard to these types of scams. We're also seeing healthcare scams on the rise. HHS, FTC, and FBI have issued warnings about healthcare scams that run the gamut from fake cures for COVID-19, fake vaccines, counterfeit tests, and the like. And then scams involving virtual currency. Over the summer, FinCEN sent out an advisory about virtual currency scams involving social media accounts. You might recall there was a Twitter scam over the summer where some celebrities' accounts were hijacked and they urged people to send them payments of virtual currency. And the FBI has also warned the public of similar types of scams. And then, of course, really germane to this presentation today is stimulus-related fraud. Almost every agency imaginable has issued warnings about looking out for PPP fraud and unemployment benefit fraud, which is also intertwined often with identity theft. Next slide, please.
Hey, Gina?
Yes.
Before you move on, I always like in these presentations, and I don't want to take more than 30 seconds here, one of the things that we've seen, for example, we had a client who had an email come in from their European offices after hours, really before hours actually, early in the morning, saying that they needed funding to take care of a deal that had been publicly announced. It wasn't that large, but that they needed the cash for that deal, and giving wiring instructions for that transaction, and then wiring the money without checking internally appropriately in those checks. And the wiring instructions were to an entity in a country that was very hard to deal with from the United States and had nothing to do with the company itself. We are, I think, seeing quite a few novel and unique scams coming in from because everyone's working at home. Is that something you've been seeing both internally when you were at the government and now that you've joined Mayor Brown?
Yes, actually, we were seeing. So I left the government in the summer, so I was there at the beginning of the pandemic, and we were seeing a slight uptick in those types of scams. And since then, it's really taken off. And I think because everyone's working remotely, I think if you were in the office, you might pick up the phone and say, hey, did you send this to me? Or, it's easier to get in touch with people, or you could walk down the hall and ask a question. Did you, does this sound right to you? But because people are isolated in these sort of work from home pods, that communication just isn't happening. And so people are maybe less inclined to double check things before they send it off. And so I think there has been an increase because there's the opportunity, and it's been very successful. So FBI has actually issued a very extensive advisory about this. And so I think, that's usually prompted by the fact that it's happening. And I'm sure we'll see more of these cases being brought by DOJ as the pandemic wears on. So, and related to that, DOJ really snapped into action at the outset of the pandemic. As I mentioned, I was still with the Eastern District at the beginning, and I can really say that the speed with which the U.S. Attorney's offices snapped into action to address COVID-related fraud was really remarkable. Strike forces were established to pursue price gougers and PPE hoarders and fraudsters within, a matter of days after New York City at least went on lockdown. And in fact, DOJ charged its first COVID-related case on March 25th, 2020. So that just gives you a sense of how quickly things happened. And part of the purpose for moving so quickly was to stop the fraud, but it was also to send a message to deter anyone who might consider committing similar crimes, to just stop them from doing it before they even thought about doing it when the country was in such a desperate situation. The DOJ has filed approximately 33 cases across the country related to COVID fraud schemes involving scam vaccines, treatments, testing, or price gouging and the sale of scarce medical supplies. And it really appears that DOJ is pursuing PPP fraud cases with the same vigor that they applied to those price gouging and PPE fraud cases early on in the pandemic. And, indeed, nearly simultaneously with the establishment of the PPP program, and I think this was one of Rich's earlier slides, the DOJ created a PPP-focused team to tackle fraud arising from the program. And it was beginning to bring cases literally within weeks of the rollout of PPP. And so I have this quote here from Acting Assistant Attorney General Rabbit, which I think really encapsulates the approach that DOJ is taking to pandemic-related fraud. They're moving quickly to identify it, they're making sure to hold these fraudsters accountable and seek really stiff penalties to make sure that they deter others from benefiting from American suffering. So just taking a look at some of the DOJ PPP cases, that's a lot of acronyms, cases to date. So there have been 73 prosecutions in the last 7 months, which is a really extraordinary number. And actually, this number may even be outdated because I thought there were a couple new cases brought in this past week. So I think we may be up to 75 here. And the cases collectively are looking at the intended loss of well over $220 million, which is, really, it's a big number, but a small drop in the bucket in relation to how much PPP money has gone out the door. But I'm sure that number is going to increase as, for reasons we'll get to in a moment. The cases have been completely limited to borrowers at this point. But I think in looking over all of these cases, what you're seeing is that DOJ is going after the low-hanging fruit. One way of having that desired deterrent effect of going after a lot of cases quickly is to pursue the maximum number of fraudsters to have sort of a general deterrence effect. So in other words, they're looking for cases where the fraud was just blatant and very readily apparent and easy to prove. So the majority of cases we're seeing involve fraudsters who blatantly lied on their applications, used another person or business's identity to apply for the application, or spent the money on cars and jewelry instead of their businesses, and those types of really clear frauds. And I'd say the majority of the PPP fraud cases brought so far fall into two categories. One is individual borrowers who, as I mentioned, engaged in blatant fraud. So maybe they lied about having a legitimate business. They claimed they needed PPP funds to pay for employees, but instead used the money to purchase luxury goods or home renovations, or even gambling in Vegas. So really very clear, not using the money what it was intended for. But I'll give you some other examples of similar cases in this vein. There's a case recently brought in the District of Hawaii against a CEO of a company who allegedly submitted at least 2 fraudulent PPP loan applications and received approximately $12.8 million in PPP funds, and then immediately transferred a large proportion of that into his own personal accounts for personal use, not business use. And according to the charges, the CEO falsely inflated the number of employees on his loan application and falsely certified that he as an affiliate his company and its affiliates would not receive another PPP loan, but in fact, he applied for a second one, and so double dipped, so to speak, when he was not when he was not permitted to. And for those actions, the U.S. Attorney's Office had charged him with bank fraud and money laundering. And an even more stark example of the similar type of fraud, in another case, a business owner allegedly stated in his application that he had 68 employees, that he had paid wages over the course of 2019, and that he had paid those employees in compensation up to $2.8 million. But in fact, his company had done none of these things. The company had 0 employees, no payroll expenses of any kind, and was not, in fact, an operational business at all. So it gives you a sense of, sort of these low-hanging fruit, like very clear fraud, no gray area types of cases that DOJ has pursued to this point.
Sorry, I was just going to ask you a question. Do you have a sense of where the DOJ is getting information with respect to, that low-hanging fruit? Like, do you have a sense of whether they're getting it through either, SARs filed by financial institutions or other types of whistleblowing or through the SBA?
I don't have a really great sense of that because some of these cases are so early and they're in such early stages. There's not a sense of like what the evidence is or where they're getting it from. So I'm sure it's coming from a variety of sources. And I'm going to get to the SARs in a moment because there have been an incredible number of SARs filed since the onset of the PPP program. So financial institutions are clearly taking this threat very seriously. But I'm sure it's a combination of factors, and it might even be one of these things where, after some of these applications have gone through, people realize, or financial institutions realize that there are issues and they may be reporting it to the authorities, but it's not really completely clear at this point. So a second category of cases that DOJ is pursuing, and I think where the majority of their resources are going to be going forward, are organized conspiracies to apply for and share the proceeds of ill-gotten PPP funds. So, one case that received a lot of attention in the press, I think about a month or 2 ago, is a case out of the Southern District of Florida against a fraud ring involving a professional athlete. And in that case, the fraud allegedly involved 11 people who collectively prepared and submitted 90 PPP loan applications totaling $24 million in requested funds. And the scheme ultimately netted about $17.4 million in dispersed funds, which were then, of course, not used for businesses. They were used to pay for luxury goods and the like. But this is not the only example. There's actually a case charged this week where, they had 7 people who conspired with each other to file 80 PPP fraudulent loan applications that totaled about $16 million in funds. But in support of the applications, they were submitting fraudulent bank records, fake federal tax forms, and that loan applications were on behalf of companies owned by the people who were charged in the case, but also on behalf of companies owned by third parties. So they had sort of a kickback arrangement where these third-party business owners would give their information to the fraudsters, and then in exchange for that, they would get a kickback payment. But they ultimately, the people in this fraud ring allegedly laundered the money by writing checks from the companies that received PPP loans to fake employees. So that is another money laundering scheme that they're seeing in these types of cases. So according to recent public statements by officials at DOJ, although they've been going over those low-hanging fruit individual borrowers, it appears that these larger scale PPP fraud conspiracies will be the cases that DOJ is really going to start focusing their resources on going forward. So, as Rich mentioned, past his prologue, what we're seeing here is, in the context of PPP fraud, are multiple agencies examining fraud in this area. And in fact, DOJ, in bringing these cases, is working with multiple different law enforcement agencies. So it goes well beyond the traditional law enforcement partners that DOJ typically works with, like FBI, IRS, Homeland Security Investigations, or U.S. Postal Inspector Service. And it's also included Office of Inspector General for multiple different federal agencies that you don't see so frequently in traditional fraud cases. So for instance, DOJ has worked in conjunction with the Federal Housing Finance Agency, OIG, and the Federal Deposit Insurance Corporation, OIG, to bring some of these PPP fraud cases. But notably, the FBI alone has opened several hundred PPP-related investigations involving nearly 500 suspects and hundreds of millions of dollars of loans. And that number is just expected to grow exponentially over the next several months. And again, just, echoing, Rich's predictions based on his experience, we are seeing DOJ coordinate and work together with state and local authorities in relation to COVID-19 fraud across the board. And one example, and I think this was in one of his earlier slides, is Connecticut. They are the Attorney General, the U.S. Attorney's Office, the FBI, and the Chief State's Attorney formed a joint federal-state task force to combat COVID-19 related fraud in Connecticut. And states are doing this across the country. And basically, the task forces are investigating and prosecuting a wide range of misconduct related to the COVID-19 pandemic, including, more of what we saw at the beginning of the pandemic: price gouging, healthcare fraud, consumer and small business scams, lending scams, cyber fraud, and then, of course, they're going to be taking a hard look at government program fraud like that arising from the PPP program. Now, what we're also seeing is that the Treasury Department, the Small Business Administration, which was in charge of administering a lot of PPP, and FinCEN have been closely monitoring the fraud problems endemic to the PPP program. The Small Business Administration Inspector General, which I'm sure will play a large role in a lot of these prosecutions, they noted last month that there is widespread abuse in the program, which is not a surprise to anyone at this point, and noted examples like the following. They're seeing companies applying for PPP that were formed after the pandemic began. They're noting that there were businesses that received money that had workforces that exceeded the 500 employee size limit, or borrowers who are listed on a federal do not pay database because they already owe money to taxpayers, they still received PPP funds, which they were not supposed to. So I anticipate we'll see more and more prosecutions of that nature as time wears on. And Treasury and FinCEN have been, as I mentioned, have been closely monitoring COVID-related fraud by issuing SARs and putting out advisories to help financial institutions detect fraud and avoid laundering the proceeds of fraud. Hit the next slide, please. So what are some of the other enforcement risks? I mean, as Rich mentioned, there's a large area of potential liability for lenders in the area of PPP. In the cases that have been brought so far, the lending financial institutions are really the victims of bank fraud because the borrower made false representations to the bank in order to obtain the PPP funds. But the concern remains that regulators and law enforcement agencies will turn their lens to lenders and scrutinize lenders for their role in failing to detect fraud if it was widespread in their institutions, or if there were serious lapses in their BSA and anti-money laundering compliance procedures related to these fraudulent PPP loans or other COVID-related frauds. For example, I think they'll be looking at whether, a lender consistently missed major red flags in PPP applications. Like, for instance, in a lot of these reviews of issues with the PPP program, one of the major red flags is the fact that in a lot of the applications, there's significant missing information in the borrower field of the applications, yet the borrower was issued payments of PPP loans anyways. And that's been a real consistent problem that I could see being an issue down the line. So, I think in acknowledgement of this risk, as I mentioned, the Treasury Department and FinCEN took steps really early on to alert financial institutions to the red flags accompanying COVID-related fraud. FinCEN had issued advisories throughout the spring and summer addressing COVID-related fraud and potential red flags for financial institutions to look for. And again, this ran the gamut of all types of COVID fraud. So they gave guidance on red flags in relation to medical-related frauds, price gouging, PPE, and non-delivery fraud of medical-related goods. And some of the common red flags FinCEN highlighted were customers engaging in transactions to or through personal accounts related to medical supply or other medical sales, payments that were unusual for the type of transaction or for the industry's pattern of behavior, such as, the use of virtual currency, prepaid debit cards, or the use of MSBs to pay for medical goods, and then some more traditional sort of BSA or AML red flags, such as a lack of lengthy corporate history. Was the corporation stood up in March or April, and then website irregularities. And I anticipate these red flags will become even more relevant and significant as we are now moving to the phase in the pandemic where this new vaccine is being rolled out at the end of the year, the beginning of next year. I can really foresee fraudsters trying to take advantage of the public's rush to obtain the vaccine and seeing more of this type of fraud on the rise. So, as I mentioned earlier, as the fraud has evolved to include unemployment fraud and government benefits fraud, FinCEN has responded. So in October of this year, FinCEN issued an advisory synthesizing information about red flags or indicia for financial institutions to look for detecting unemployment fraud. It's also provided guidance on how to properly file a SAR for suspected unemployment insurance fraud and identified multiple typologies of different types of unemployment fraud. So for instance, they ask financial institutions to be on the lookout for fictitious employer-employee fraud, where the employee falsely claims employment with a legitimate company or creates a fictitious company and then submits fictitious records to apply for an insurance benefit or unemployment insurance benefits, as well as misrepresentation of income fraud or identity-related fraud. Now, with regard to PPP fraud, which is sort of our main topic for today, FinCEN has issued some guidance back in April 2020, right when the program was being rolled out, about financial institutions know your customer obligations with regard to PPP loans. And specifically, they noted that PPP allowed lenders to rely on existing KYC processes when issuing loans. So for customers that were already customers of the financial institution, there was really no need to obtain new KYC information. But on the other hand, lenders were required to collect KYC information on new borrowers, but only on individuals with a 20% or greater ownership stake in the borrower. So they're, I think in recognition of the rush to get these funds out, they let up on financial institutions to some degree on, really running to ground a lot of the KYC information that they would normally need to collect. But FinCEN further advised that lenders follow a risk-based approach to BSA compliance, including, KYC for new customers, as I mentioned, and then doing enhanced due diligence for high-risk customers. And the OCC similarly has recommended a risk-based approach to BSA compliance in this context. So in this vein, it's important that lenders identify their high-risk borrowers. Most lenders obviously already have an existing AML risk rating, but it was important that they tailor that risk rating to schemes that have already been seen in the PPP fraud cases, like ones I've described today, and then adjust it as new ones arise. But one thing is clear, and as I mentioned earlier in response to Michelle's question, financial institutions have taken heed of the warnings about fraud that is running through the PPP program. And that's really been indicated by the sheer number of SARs that have been filed in the first 7 months of 2020. In September 2020 alone, the Treasury Department received 2,495 suspicious activity reports involving business loans from banks and other depository institutions. And that's actually more than the total for any year dating back to 2014. FinCEN's been out there doing education about the types of frauds they're seeing, and one in particular that they've noted is multiple government payments from coronavirus relief programs to a single account. So that's something that's come up in a lot of the SARs that have been filed. Now, I think, what we can expect is with the loan forgiveness application process coming up, that there will be another chance at detecting fraud. The way the program is rolled out, it made it very difficult for both lenders and the government to really root out fraud before dispersing funds. But now as we get to the stage of the loan forgiveness applications, lenders and law enforcement will have another opportunity to detect fraud. Lenders have 60 days to scrutinize loan forgiveness documents, and they should use that to really scrutinize those documents, verify the accuracy of calculations, ensure supporting documentation is contemporaneous and authentic. This will give another opportunity for lenders also to take a look back at some of the documentation and information that was submitted at the application phase to help root out fraud and prevent it from happening again. Next slide, please. So, what have we learned? So as predicted, when the PPP program was rolled out, there was a substantial amount of fraud, which is already being vigorously pursued by federal law enforcement. They've gone after the low-hanging fruit, but I think now they're turning that lens to these more complex cases. But in bringing those more complex cases, I think there could be issues with gray areas and subjectivity and making prosecutorial decisions about which cases to pursue. There's a question about how to address borrowers who, made this, this is an honor system, so they had to certify that they needed the funds to carry on business activity. But, in April or May, when we're still figuring out, what was happening with this virus, what's going to happen with the economy, there may be some businesses that made that certification, but they ultimately did really well and didn't need the funds. I think one could argue that. So there's going to be a question of whether those cases will be pursued because, of course, prosecutors need to prove criminal intent. And I think in those instances, it'll rely on a lot of subjectivity and will be difficult to prove. In contrast with the cases that we've seen charged already where a company says they have employees when in fact they have none. I mean, that's an easy one. And, next we're going to see SBA and Treasury audit of PPP loans greater than $2 million. Under that framework, a lot of loans won't be scrutinized. The SBA has left some wiggle room in there for additional auditing as appropriate of other loans, but it still remains to be seen what criteria will be used for this audit. I think we'll see other regulatory agencies step in to assist the SBA in the enormous task of auditing PPP loans. We're already seeing the Department of Labor stepping in to do that under the guise of routine wage and hour inquiries. So I think we may see more regulators stepping in to assist DOJ with, after they do these audits to pursue additional cases. I think we can expect additional scrutiny from Congress. The Senate Select Subcommittee on Coronavirus Crisis issued a report in September that was critical of the current administration's efforts to devote resources to rooting out fraud. So I think we'll see more scrutiny from Congress. There's a new administration coming in. The Biden administration campaigned on campaigned on anti-corruption in the government, and I think they're going to focus a lot of their efforts on government programs like PPP and devoting more resources to prosecuting those cases. And related to that, I think whistleblowers will play a big role in these cases. And the Biden campaign stressed that giving more power to whistleblowers and more protection to whistleblowers was a priority. So I think that we'll see whistleblowers playing an even more important role in PPP prosecutions going forward. And with that, I will turn it over to Michelle.
Thanks, Gina. So next slide, please. So Gina just outlined for us the government's oversight and focus on COVID-related frauds. And what I want to talk about is how, from a practical perspective, that translates to compliance concerns for firms and businesses, and to discuss how, we can minimize that risk. So, we start with client exploitation of COVID-19 programs. Rich and Gina, they pointed to a lot of evidence that the government is focused on fraud in connection with the COVID relief programs. I don't know about everyone else, but I'm certainly persuaded that they are right. A lot has already been done. I think more will be done. And as Gina said, just ended on, the government so far has really limited its scrutiny on purported fraudsters. I think we all, from experience, know that, that the government will eventually, look to banks and other financial firms that facilitated the fraud. From the perspective, two perspectives, frankly, from the one perspective of, were any of the banks, firms, financial institution advisors complicit in the fraud, right? And I think already they've located, I think some of the investigations have uncovered bankers who have participated actively in the fraud. But the other is just whether, the banks were in a position to prevent the fraud. And, I think that, we know from the past, the government very quickly government and regulators refers to the banks as gatekeepers. And, as Rich said, the $659 billion has been dispersed. The average size of each of those loans, only 100,000. So that's over 5 million borrowers. Sooner or later, the prosecutors and the government are going to shift the focus to the lenders because it's just going to be more bang for your buck. And I agree with Gina, there's low-hanging fruit there, and some outward overt fraud. But, I think at some point, and particularly maybe not even the DOJ, but the regulators are going to look and say, well, where were they getting these loans from? And, how could that have happened? And, we'll ultimately get there. And the truth is, you've got the criminal, what are the threats here to the businesses, right? There's the trifecta. You've got liability, right? So, and whether that's criminal or civil liability that you're concerned with. And then you have regulatory scrutiny, right? So there's some exposure to the regulators. And then there's reputational harm. I think we already have seen quite a bit in the news with some major financial institutions. And, that's just something I think everyone wants to keep their eye on, and you want to, make sure to the extent you can minimize any one of those three, or perhaps all three. You want to focus on doing that at the outset. In addition to the COVID-19 programs, I know Gina mentioned, and I completely agree, increased email fraud and cyber threats. Even before the pandemic, there was a significant increase in email impersonation frauds. And I think that was coming out of the FBI. I know I spoke with a number of FBI agents while I was in-house who, kept saying, this is increasing, and, you could, so now with the pandemic, that is, now it's really sort of just hit the roof. So, as Gina said, I'm not going to talk about that in this webinar because we'll be having another webinar on this specific topic because there's so much to talk about in the beginning of December. The third real, I think, compliance concern that, I would focus on is employee misconduct. And again, that falls into two categories. You've got, employee misconduct where there's, the possible conspiracy. So your employees may be actively involved in the fraud. But there's also personal fraud outside of work. And, I think already, we've heard from two very public announcements with respect to two very large financial institutions who fired, in one instance, over 100 employees. Who they discovered had themselves and their personal lives had made misrepresentations in order to receive, coronavirus relief funds. Some may say, well, what does it matter? These are employees, and they may be employees, but what they're doing is individual, and it's personal. But the truth is, from a practical perspective, employees' misconduct outside of employment is still an employer's problem. The company has to deal with whatever ethics reports and other complaints that are made with respect to the allegations. The companies have to expend resources, frankly, to investigate these issues. They have to make complicated employment decisions. They have to make disclosures to regulators. And frankly, they have to report it to, it comes out in the media. Now you've got to deal with that reputational harm. I think, in the two public instances, it's also the two, the employers were also the lenders for a large number of PPP loans. So, I mean, it just also creates, some trust issues. Next slide, please. So, I'm going to try to go through these pretty quickly. And I think, with respect to these frauds, they're similar to other issues and other frauds. You've got some potential pitfalls that really sort of, fly off the page. Existing policies and procedures simply being inadequate. I think I have here square peg and a round hole problem, and that's really sometimes the case where, you look to your policies and, you haven't defined perhaps, fraud or your anti-fraud measures really to address the evolving fraud. And, policies and procedures, I mean, they're, really important, of course, from the perspective of, trying to vet out any issues and trying to make sure that you've got the right procedures in place in order to deter fraud, to discover it, and that kind of thing, and to make sure that you as the business is upholding, your obligations and responsibilities in whatever your role might be in connection with, if it's PPP, maybe you're the lender. But also, it's the first thing a regulator asks. The first question is going to be, what were your policies and procedures around this issue? Okay. Now you've got to say, you've got to look to them, and, either they are, hopefully they're sufficient. So, and then, and that's why we really need to spend time looking at it. And then, of course, the next question is, were your employees in compliance with those policies and procedures? And you really want both of those questions the answers to both of those questions to be yes in an ideal world. I think red flags, in my experience, they are the most significant element with respect to, again, I'd say all three, both liability, exposure, regulatory exposure, as well as reputational harm. And, at the end of the day, I've got, willful, reckless, negligent. I mean, I think, the intensity of the red flags, the quantity of the red flags. I mean, that's really at the end of the day, how, where a company's liability is going to rest. I think organizations face the difficulty that employees will put on blinders, and, they just do their job. I think that is increased significantly right now because employees are isolated. And I know Gina made this point, and I think it's spot on, where maybe they would have escalated a concern if they were in the office. They may simply just, push it forward to get whatever it is they have on their plate in order to get it done. Another major issue is where employee incentives are aligned with fraudsters. And again, we can look to history on this. There are lots of instances in which, bonuses, commissions, those sorts of things are tied to the purported fraud. And here, I think that's the same. I mean, a number of, whether there are commissions, so it doesn't have to be a kickback necessarily in order for there to be some negative, some adverse inference drawn. I think same thing, and both, the government regulators as well as civil plaintiffs will, try to create something nefarious out of, sort of bonuses being tied up perhaps with the purported fraud. And I think it's just something the company needs to be aware of, and you need to be more critical where those situations are lined up. So sort of the opposite of the pitfalls, right? So the controls, your best offense is a defense. I think just generally, I think particularly when we're talking about these fraud risks. So in particularly here, I mean, we Gina's really focused on this, Rich as well. You've got a number of regulators and entities and enforcement agencies that have come out and offered all this guidance. They've offered these advisories. They've now told you, the businesses, perhaps, particularly if you're a financial institution, what you need to look out for. You're going to be hard pressed to say, well, we didn't know, right? So take that guidance and look to your policies and procedures, and where you can make. I mean, I bet you if we looked at a lot of companies, large companies, policies and procedures, they have not been revised to address the fact that most people are working from home, that their employees are working from home, that their clients are working from home, and so I think it makes a lot of sense for companies to spend some time looking at those procedures and just sort of getting them up to date. And then you need to audit, right? I've certainly been in the situation where we have to say that we have brought non-compliance with policies and procedures, and again, unfortunately, that's going to be an adverse inference that's going to be drawn. So taking the time to be proactive and audit compliance. Red flags are flags, right? Specific fraud training. I think you want to just look, either from real live examples, from peer firms, look to see, and really train employees on red flags. I can't harp on that enough, because I think in my experience, and I've done a large number of third-party fraud investigations, like a very large number, and it all rests on red flags. Whether whether that means you're going to get a favorable result from a regulator, or you're going to have to pay your client, even if the business didn't receive the funds, you got no benefit from the fraud. But if you've got glaring red flags, I know Gina went through a bunch. There's a bunch to go through here. But taking the time to look for those, I think is important, and then training employees. And then I think the other two are pretty obvious, right? I mean, you need to document everything, and disclosure is important. And that, I mean, it's a simple point. It's a complicated analysis. What kind of disclosure needs to be made, to whom the disclosure needs to be made. I'm very interested in the SARs that are coming out, and whether that line, and I think there's going to be a question about whether those SARs line up with what a financial institution may be doing internally. And so, are they simply reporting the SARs? What are they doing themselves to be proactive to prevent the fraud? So I'll end there. If there are any follow-up questions, everyone should please, you have my email address. Please feel free to email me or Rich or Gina.
So I can calls with Michelle and Gina, because I'm kind of wonky and I didn't get enough. I'm interested in Michelle and walking you through internally some of the stuff that you were talking about. But that concludes today's webinar. We hope the information was useful, and thank you so much for your participation and attendance. Have a great day, everyone.
Thanks, everyone.